Since putting in cycle highs in late September, the US dollar has fallen almost 10% against the dollar index. Now, both the euro and the yen have led the way higher with more than 10% gains in each. However, the Canadian dollar has been a conspicuous laggard, posting a current 3.3% gain since the lows in the fall. Now, the primary driver of the loonie's underperformance is likely tied to the price of oil, as oil has fallen 25% since June as fears of a global recession loom. Since December 9th, though, crude has gained over 14% on optimism from China's reopening and on talk of domestic need to restock the Strategic Petroleum Reserve. The Canadian dollar has had a corresponding 1.5% gain alongside crude. On Friday, December 23rd, Canada's GDP numbers came out at plus 0.1% gain in November, which was in line with expectations, but there was a promising upward revision to the previous data. Now, prior to the GDP data, there had been some speculation that the Bank of Canada was nearing a pause, and the surprising strength has pushed that notion further away. Now, the CME offers three different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believes that the recent strength in the Canadian dollar could accelerate, they could express that by buying the March micro Canadian dollar contract at 0.7415 and targeting a move to the November highs of 0.7570. A stop for this trade could be placed below at 0.7350. Now, this trade could make $155 if the target is reached and risks $65 if you're stopped out of your level. Now, if a trader believes that the loonie will head lower from here, they could express that by selling the March micro Canadian dollar at 0.7415 and targeting a move back to the October lows of 0.7200. A stop for this trade could be placed above at 0.7545. This trade could make $215 if the target is reached and risks $130 if you're stopped out of your level.